Hi and welcome to Symax Fintech weekly report. This is part one. Here we're going to cover some of the macro and then we'll come into the technicals on part two and part three. First of all, our disclaimer, please read it carefully. Trading involves the risk of loss of capital and it's not suitable for everyone. Hopefully it is for you. And many companies provide leverage, so you should be aware that you can lose substantially more than your initial investment. The views, opinions formulated in here are mine, Chris Tubby, and all we're trying to do is provide you with some just insight into what's going on, but it is purely for educational purposes. So it's not investment advice, or we're not encouraging you to trade or invest. That has to be your decision. And of course, you should carefully consider your risks, your financial situation, definitely your level of experience, and obviously only risk capital that you're prepared and, more importantly, can afford to lose. You should seek financial independent advice if you have any doubts whatsoever before you risk your capital. Okay, so when we come on to highlights from last week, really. So the first thing is Macron. He won the French election. It was more just to prevent Le Pen winning. He's not that popular in France, but you know, he would have possibly got about 40% without others coming to his aid, just to prevent Le Pen from winning. Musk bought Twitter. Obviously, it's not a done deal yet. It's not signed, but it's been agreed. Now, you know, I paid a lot of money for it, $44 billion. So far, he sold $8.5 billion worth of Tesla shares to raise some of that finance. In total now, in the last 6 months, he's actually sold about $25 billion worth of his Tesla stock. And of course, some of those sales, especially the earlier ones, were against tax liabilities that he had. So he's got about 3 billion cash, it's supposed anyway. And of course, personal investment is 21 billion. So I think at the moment he's probably about 10 billion short. So it's a matter of how he's going to raise that. Is he going to sell more stock, or is he going to look at different ways to do that? And of course, you know, if he does go through with this and he does buy Twitter, then it's going to be interesting to see what happens with crypto, because he's a big fan of crypto. Will he have Twitter payments in crypto, for example? We'll have to wait and see. Earnings have been a mixed bag. Some companies have been doing well, others not so well. Obviously, Amazon crashed, lost about 40% of their value. And of course, you know, they've sort of been losing their customers recently, you know, their subscribers, 200,000 so far, and there is a prediction that that could actually increase up to possibly as many as 2 million. Again, have to wait and see. They put prices up, that might compensate a little bit. But of course, it's natural now we're all out and about that we're going to watch less sort of Netflix and other things, Amazon with their subprime, and possibly, you know, we're going to do more natural shopping in the high streets rather than ordering everything. So yeah, you know, I don't think it's the end. Let's wait and see what happens with those. Commodities, they dropped and then they had a bounce. And part of that was down to China. So their lockdowns obviously is impacting their production and their demand. And it had a rally towards the end of the week when China vowed to boost their economy. You know, sort of commodities have been bouncing around and quite volatile, just obviously with different things that are going on around the world, which I'm going to cover. Again, wheat, you know, when you've got two of the top five exporters of wheat at war, it does make it a little bit more difficult to access some of these products. And you know, we just have to wait and see what happens with WTI, because that bounced also. But there's a lot of pressure coming from the fracking industry, especially in Texas, where a lot of it's done. It's increasing earthquakes there. They're about number 3 on the global list of earthquakes at the moment. And then we move on to currencies. The USD, so the dollar is strong. It's just been strengthening further, just on the back of their economy, and of course the expected interest rate hikes. And the first one we should see this week when we get the FOMC meeting. The pound is weaker. I think that's a bit of inflation. It's a bit of a burden to consumers. And then the euro and the Japanese yen are weaker, just with low expectations, probably on the rate front more than anything else. Of course, Japan is a very big importer as well. So, Japan, sort of the yen against the dollar, it's at 20-year lows. It's lost actually 11% in the last 7 weeks. Now we're going to look at key data for this week. There's plenty out, so I've just highlighted a few of the key things, not all of it. We've got retail sales coming from the EU. The US, it's going to be a great week. There's PMI out. We've got FOMC rate decision on Wednesday, and then NFP on Friday, non-farm payroll. So that'll be interesting. Again, there's expectations for rate increases, which I'm going to cover in a minute. For non-farm payroll, just focus on earnings and the employment level. NFP is expected at the moment around about 400,000. The unemployment levels back to pre-COVID levels of 3.6%, which is, you've got to consider that full employment. Consumer credit is increasing though. And of course, all this inflation is now sort of eroded all the savings that accumulated from the lockdowns. And if asset prices, the stock prices continue to drop, maybe house prices eventually, then again, that's going to sort of start to reduce the valuations of households' assets. Along with that, we've got the UK, so we've got the MPC rate decision. Again, we're expecting another increase there. And of course, this week, being the beginning of the month, there will be an OPEC meeting as well. So just a little bit on the macro outlook. Again, as I said, it's an exciting week ahead. These rate decisions from the Fed and the Bank of England. We're expecting the Fed at the moment, the general consensus is a 0.5% increase, which will put them at 1%. And of course, then after that, we've got the Bank of England on Thursday. MPC meeting there, we're expecting at the moment a 0.25% interest rate increase, which will take them up to 1% as well. So the US and the UK will both be at 1%. Now this should start to trigger some sales from the balance sheets. If you look collectively at sort of 4 of the bigger balance sheets, China, the EU, the USA and Japan, between them they've got over $91 trillion in assets. That is a lot. And of course, they've got to start to ease that, in preparation for the next crisis, whatever causes that. So they're going to be looking to reduce those balance sheets, probably a bit more aggressively than usual, just because they've increased by so much. Just a note here for the US Treasuries, they've actually got a record tax receipts coming into them. So again, that's going to be a little bit helpful, especially with the amount that Biden spent since he's been in power. And then, of course, when we move on away from that, we've got obviously the NFP, as I mentioned before, just focus on the earnings and the jobless rate. And then we've got this inflation situation, haven't we? And that's obviously concerning everybody at the moment. We've also got shrinkflation, and as a chocolate lover, trust me, I've seen that, where your product gets smaller rather than them charging you more. Then we've got stagflation, which is really inflation but without any growth. It's almost a recession. And then we've got the chance of a recession as itself. So all of this, not necessarily this year, but it is looking as though some of this could appear sometime on the horizon. We'll have to see a bit more data and how the central banks manage things, because if they start to put rates up too aggressively, people are already having to spend a lot more out of their salaries or whatever they have at the moment, and that's going to cause them to have less disposable income yet again. Of course, we've still got these supply chain issues. We've got China in lockdowns. We've got Russia's invasion of Ukraine. All of this is putting even more pressure on supply chains at the moment. Semiconductors is another major one. But when it comes to inflation, energy and food price increases have been sort of dominant there. And it looks as though they're going to continue for some time in the future. Also, there's been this lack of workers, which has put pressure on earnings. Companies having to pay more, which is, great if you're an employee, and it's about time. Companies have been so keen to reward themselves and their shareholders. They tend to have forgotten about the workers in the past, but we're seeing something a little bit different now, and about time. And of course, some of the EU states could be heading for a recession already. Italy's under pressure. And then, on top of that, with this Russian gas being cut off, Poland, Bulgaria, for example, the EU is desperate to replace Russian supplies of oil and gas. And of course, this is bumping up their inflation as well, which is, is something that they definitely not enjoying. So EU inflation is running at about 7.5%, their core about 3.5%. Germany is actually running at 7.8%, which they, to be honest, they're really not going to like that. Here's just a few trading tips that I'm putting together week after week. So this is just a very easy one. It's about volatility. We've seen so much of that since COVID hit and now with the war in Ukraine as well. So, most trades are going to go against us before they turn in our favour. That's if they're going to, of course. So it's important to allow for wider stops when the markets are more volatile. Now, you've got to be careful with this because that could also increase your loss. So the way to do that is trade smaller positions. And then that's going to allow you to have your stop further away, a wider stop, but without increasing the potential loss. I call it volume versus volatility. Another alternative, if you're familiar with them and you understand them, again, it's going to depend on your level of experience. An alternative to that is buying options. I always say buy options because you know the maximum you can lose, which is the premium. We provide a lot of education on all of this. So if there's anything you're not sure of, please feel free to reach out to us and we'll help you as much as possible. Again, there's just another reminder of our disclaimer. I went through it at the beginning, so I won't bore you with that again now. And some of our services that we do provide, our daily newsletter, which includes a lot of all this up-to-date global news, as well as chart levels and some views as well. We offer workshops, courses, master classes. We do trader mentoring. We consult. If you've got any questions whatsoever, feel free to reach out to us and contact us at info@symaxfintech.com. So that's the end of part one. Hope you've enjoyed that. We're just about to start part two now, and we look forward to seeing you on that one as well. Thanks for listening.